Welcome viewers, welcome to Sentry Shala. The idea of today's session, we wanted to talk about debt markets and specifically bonds and how do they function. Today we have with us Abhay Mishra, who has been in the wealth management game or markets for the last more than 15 years with a majority of his focus on bonds and debt instruments. So we just wanted to understand from him, how do bonds work, what are bonds, what are the various kinds of bonds, which kind of investors is it suitable for. Also, essentially what someone should understand or talk about bonds when they are talking in front of their partners or clients. So welcome, Abhay.
Hi, thanks for having me. So Ankit, as in a nutshell or in a plain layman language, I'll try to explain what a bond is, how does it work, and then on top of it, how our partners can put it in front of our clients or in front of their clients, and why somebody should invest into bond at this point of time. Also, I'll try to cover all these points. So bond is nothing but a way a corporate or a government entity, or whether it's a state government or a central government, it's a form of borrowing. So when a company or a government is looking for their expansion, whether it's a expansion of their plant, expansion of their machinery, or they are looking for expansion of their businesses in different parts of the country or overseas also. So there are ways to raise money for that. One of them is purely they go to bank and borrow money and use that money for their expansion and all. Now the other way through which they raise money is they go to capital market and raise money by issuing bonds. So bond in a layman terms is nothing but when somebody is raising money or borrowing money in lieu of giving interest against that, and which is secured by way of various securities which are underlying. That's in a nutshell is a bond. Now, what kind of bonds are available today in the market? So both corporate and non-corporate, and then you have government bonds which are available. Precisely these three nature of bonds are available. So I'll give one at a time. So government bonds are basically bonds issued by Government of India or a state government, through which they raise money for various infrastructure projects which is used for development of the country and state, and in lieu of that government gives you a certain percent of interest on it. Because these are backed by government, whether it's the state government or central government, so they are highly secured in nature, and that's why they are generally categorized as the highest in terms of credit rating, and thus gives a decent return in terms of interest what is being given to the customer or end user of that bond. Now second way of issuing bonds is by the corporates which are there. They borrow money both from their short-term requirements of working capital as well as for their long-term expansion business plans also, through which, so how they raise this money, again they issue short-term papers for short-term requirements, papers which I refer to the bonds, and then they issue long-term bonds which is needed for their long-term purposes. Again, in lieu of the interest, interest can depend on the nature of that instrument. It could be a monthly interest paying bond, it could be a quarterly interest paying bond, it could be an annual interest paying bond, or it could be a perpetual bond wherein there is no tenure associated with it. And the third one is again bond which are listed by, issued by the companies which are non-listed. So you have listed bonds, you have unlisted bonds, you have bonds issued by government entities. It could be a central government or a state government bond, or it could be a PSU bond wherein the government has majority stake. That's why these are called public sector undertakings and issued by them. Now your third question, that how it could be positioned in the portfolio per se. So when we make a portfolio for any client or a corporate, now there are two set of investments which are made. One is for a short-term requirement, one you have for a long-term perspective when you are building corpus for your future needs. So if at all there is a cash flow requirement which are available, now through these bonds a corporate park their money for short-term places because they don't have a visibility for a longer tenure, and thus they cannot invest into a longer tenure of investments. They go for such bonds. From an individual perspective, now look at from a partner perspective. When you go to a client who is say 60 plus, and now a retired guy has got some retirement corpus, now there is no cash flow or inflow will be available for him for future requirement on day-to-day basis. So what he does today is that he park that money into a bank fixed deposit, and he survives on the interest income of it. Instead of going into that, which is capped at a certain percent, so the maximum interest which are available today for any PSU bank or maybe a state-owned bank would not cross more than 8.5%. Instead of that, there are corporate bonds available both on the listed and unlisted side, wherein the interest could be as high as 16% also, subjected to the risk he is willing to take, or on a moderate level, anywhere between 9% to 12% kind of a papers are available in the bond market, which takes care of their day-to-day requirement in terms of interest income. So that's one category where partners can get into these clients and pitch it. Second, when you park everything into one asset class, so we all talk about diversification. So a general saying in wealth management is that you don't put all your eggs in one basket. So diversification is the need of an hour, and especially when the markets, equity markets are all-time high, when we see that all the stocks are buzzing around, everything is going on the upper side, it makes some sense to book some profit out of it and park some money into a debt segment which is secured in nature comparatively. So the fluctuations or return changes compared to equity markets are less than, or maybe a negligible one, if I'll say, put it across to a fixed income instrument where your capital is protected and your interest or income is secured over there. Third, why at this point of time, so somebody who understands the interest rate scenario or interest rate cycle, currently we are sitting on a scenario where the interest rates are at the peak. Ideal situation, if you understand the interest rate play, so when the rates are higher, ideally that's the best time to lock that interest rate and invest money into a fixed instrument like a bond for a longer tenure, so that in future when the interest rates goes down, not only the current investment which you are making will give you a higher return, plus it will attract a capital gain also when the interest rates goes down. That I'll explain you in another example in some time, that when you buy something today at a higher interest rate and when the rate goes down, how it impacts the pricing of that bond. And last, which all options are available today. So as Ankit is a part of product team, he knows that there is a thorough research which has been done by Centricity team for whitelisting of the bonds which are available on the platform, and anybody who is looking for a as short tenure as a 1 month period to as long as a 10-year paper, all sort of bonds are being created. The whitelist has been created so that you can go back to your customer, go back to your partners and check for it that what suits you, and then you can accordingly select a bond and invest into those bonds.
That's great. Thanks a lot for your inputs, Abhay. I mean, one of the words that you used, or one of the terms that we used in the discussion, was credit rating. So I just wanted to understand, for our viewers, what is credit rating, how is it given, or how to think about it essentially.
So credit rating in a very plain and simple way is that there are rating agencies which evaluates your past performance, your financial data, and based on that, so any rating which is given to a company is nothing but the capacity and capability of repayment of your principal based on your financials gives you the highest rating. So if a company which has a very sound balance sheet, which has a very sound cash flows within their books, has been given the highest rating, which is a AAA rating, which means that the probability of getting your principal plus interest is at highest and your capital is much more secured with a AAA rated or a higher rated paper. Having said that, it does not mean that any company which is on a lower in terms of credit rating may not return your capital. It's just that the cash flows of that lower rated companies may not be that sound, which can give them a higher rating, and that's why the rate of interest which a lower rated credit paper gives you is higher than a AAA rated or a higher rated paper.
Okay, so I think it would be safe to say that the credit ratings are like CIBIL scores or CRISIL scores for companies.
Exactly, and then on top of it, Ankit, credit rating is pertaining to each paper of issued by the companies also. So there could be chance that a company is issuing a secured bond or a unsecured bond. So a rating will vary for both the papers.
Right.
So yes, it is a CIBIL score, but not pertaining to that particular company. But the paper which are getting issued, the rating is given to that particular paper.
Also, I wanted you to explain what are tax-free or tax-free bonds essentially. What do you mean by tax-free bond? Because interest usually attracts in tax as per the tax brackets, and then we hear some names such as tax-free bonds for some of the companies. We just want to understand how to go about them.
So tax-free bonds are typically bonds issued by PSUs, which comes under Government of India, and when they borrow money for a very long tenure, so they try to give a lucrative option to the investor wherein there will be no taxation on such bonds, so that the money is parked for a longer duration, longer tenure. And that's why when you invest as an investor, when you invest into such papers, there will be no taxes. So whatever income you get out of those instruments are tax-free in nature in your hand. So irrespective whether you are in a 10% tax bracket or a 39% tax bracket, you get the interest tax-free in your hands.
Okay. One more thing. Let's say I want to invest in a bond. We selected a company, and I only want to invest my money for 6 months. Are those kind of things possible? The customizations possible in this, or a paper? Let's say if I've given a fixed maturity, I have to invest only in that.
No, so how it works is that all these listed bonds are tradable in nature also.
Okay.
So even if you don't want to go to any XYZ distributor, you can simply go to NSE's website also. And if you search for bonds, so there are listed bonds which are available. So the way you buy a share today, you can buy a bond also through listed bonds through NSE portals. Similar way, you can be a seller and liquidate that paper also over there. So if you have a specific requirement that you want to buy for a specific tenor, so two options are there. One is that you can find out a bond which has a residual maturity of the tenure you are looking at it.
Right.
So suppose I am an investor who has a money only for 6 months. So I can search for paper wherein the maturity is within 6 months, so that my money is not locked for a longer tenure. That's one option is available. Second could be that you invest into a paper which is for a longer duration, but you invest it for only 6 months period. So you invest it with the certainty that you can get an exit after 6 months when you want to liquidate. For such paper, ideally you should get into a paper which is high in liquidity nature, so that the exit doesn't become a problem for you. But then these papers are available.
Okay, noted. Apart from that, one of the terms that is being used a lot in the bond market, and there are some confusions regarding these two specific terms. One of them being the coupon rate, and one of them being the YTM. I just wanted to.
It's not a rocket science. So I'll tell you, when the bond is issued, so whatever the coupon which are printed, so basically that's the interest you are entitled to get it on the face value.
Okay.
That's the coupon rate. The YTM is that whatever is the interest you will be getting it at that time of entry when you are buying actually. So there are two ways to participate or buy that bond. One is that you buy it when it is issued. Second, it is when it is already issued in nature and listed now. So it is trading with the price. So for example, now I'll give you example. There is a bond which is 100 rupees face value, and the coupon was say 10%. Now after 6 months of the issuance, so somebody who is holding this paper for last 6 months is entitled for that 5% interest for that period. So when you want to buy that bond, you will not get it at 100 rupees. You will get it 100 rupees plus 5 rupees interest which is accrued for that period. So somebody who is holding it will sell it to you at 105 rupees. So for you, the coupon will not be a 10% or your yield will not be 10%. Because you're buying price it at a higher, you're buying it on a premium, that's why your yield goes slightly lower than 10%. And that's why that interest which you'll be getting now is called YTM. For the rest of the period, you'll be getting your return on that YTM, not on the coupon price.
Sir, what we have seen, whenever we explain bonds to people or whenever we explain bond to partners, one of the confusion a lot of people have in bonds is a difference between YTM or the difference in between yield and the coupon rate. So I just wanted you to explain to our viewers that what these terms mean.
So basically coupon is nothing but the printed price which is mentioned while the paper is issued. However, the YTM is in a layman terms is nothing but the yield which you will get if you hold that paper till maturity. So that's why it's yield to maturity.
Sir, apart from that, I wanted to understand, for the viewers and for, the wide audience essentially, is what is the minimum investment someone can do in bonds?
So that's very tricky. So it depends on the nature of the issuance. So for public issuances which are available today, investor or anybody can invest as low as 1,000 rupees also. In fact, for GSEC they can go up to 100 rupees also, which are available. However, for unlisted papers, the minimum investment is still 1 lakh rupees per bond.
Sir, what is the expected return someone can get out of bonds? When you talk about equity, the expected returns usually people have in between 12 to 15% range. What is the return that someone can expect if they invest into an asset class like bonds?
See, again, people have a myth that bonds only indicates a single digit return or highly secured in nature. So both the aspects, whether it's secured in nature or low in return, a person who is investing into a bond can anywhere expect a 5% return to a 15% return also, subjected to what kind of a risk he is willing to take within the bond also. The only difference between a bond investment with a high risk and a equity is that the return certainty in a bond is pretty much secured. So the day you invest into bond, whether it's a rated AAA or a BBB, you know what kind of a return you should expect, and that is fixed from day one itself, wherein a return on equity is not prefixed. So it may vary, but there is no certainty on return on equity, but in bond it is fixed, and anybody like you and me can have a paper of 12% bond also or a 15% bond also, that is subjected to the rating category or a credit he is comfortable with. Okay. So just to give you an example, at Centricity also we are advising few papers wherein the returns are anywhere between 12 to 14% also. Okay. So slightly lower on the credit side, but cash flows are there to support that, and that's why we are recommending people who is willing to look into it. And if somebody is looking at a very highly safe paper, so he can expect anywhere between 5.5 to 6% kind of a yield on that.
Thanks a lot, sir, for your time. It was great having you here, and our viewers learned a lot from you today. Thank you.
Yeah. Thanks for having me, and do invest into bonds. This is the time when we all should become a bond by investing into bonds.
Also, I would request you to request all the partners and all the viewers to like, share and subscribe to our channel. Thank you, sir.
Thank you. Thanks for having me, Ankit, here. Thanks. And do subscribe.